Brad Williams, Frugal Finance, creating synthetic securities with swaps. In other sections, we saw that certain securities could be synthesized from combination of derivatives. For example, a forward put-call parity. In interest rate options, we explored the put-call parity relationship, which shows how any three of four instruments, a put, a call, the underlying good, the risk-free bond, synthesize the fourth instrument. In swaps, we saw that swaps could be analyzed as a portfolio of other instruments, such as a portfolio of bonds, a portfolio of floating rate agreements, or a portfolio of options. Exploring the creation of synthetic securities has two motivations. First, it provides a deeper analysis of swaps and an understanding of how to use swaps to change the form of existing instruments. In swaps, we showed how to deconstruct swaps in terms of other instruments. Now, we show how to construct other instruments using swaps. Second, by seeing that an existing security is equivalent to a synthetic security, we learn how to compare financing and investment alternatives in the search for cheaper financing costs and higher investment returns. The synthetic securities discussed in this section are quite simple in character. As we will see later in this section, they're akin to fundamental building blocks that can be combined to create more complex and flexible financial structures. Synthetic fixed rate debt. Consider a firm with an existing floating rate debt obligation that wishes to eliminate the uncertainty inherent in floating debt. A firm in this position could create a synthetic fixed rate debt instrument by combining its existing floating rate obligations with an interest rate swap. Assume that a firm has an outstanding issue of $50 million, of which it pays a floating rate annual coupon, and the debt matures in 6 years. The firm wished to transform this obligation into a fixed rate instrument with the same maturity. Figure 22.2 shows the firm's existing obligation in the upper timeline. To transform the existing obligation into a fixed rate instrument, the firm can engage in a swap agreement to receive floating, pay fixed, with a 10-year end payment timing to match existing debt. As shown in the bottom timeline of figure 22.2, the combination of the existing debt and the pay fixed, receive floating interest rate swap gives the firm a synthetic fixed rate obligation instead of its current floating rate debt. An existing fixed rate obligation can be transformed into a floating rate debt by reversing the technique used to create synthetic fixed rate debt. Assuming that a firm has an existing fixed rate debt obligation with a maturity of 6 years that requires annual interest rate payments, the upper timeline of figure 22.3 shows the cash flows associated with this obligation. This example parallels that of 22.2, except that the initial obligation has fixed rate coupons. By combining these fixed rate obligations with the receive fixed, pay floating interest rate swap, the instrument can be transformed from a fixed rate to a synthetic floating rate obligation. The lower timeline of figure 22.3 shows the cash flows on a receive fixed, pay floating interest rate swap. By combining this swap with the existing obligation, the firm transforms its existing fixed rate obligations into a synthetic floating rate debt with the same maturity. Brad Williams, Frugal Finance.